Rethink Your Wealth is brought to you by UOB. UOB, right by you.
You're listening to Money FM 89.3. I'm Ryan Huang. Gold has been on a remarkable rally over the past year, reaching record highs and capturing the attention of investors worldwide. This surge has solidified its reputation as a reliable asset, particularly during times of uncertainty. But is the gold rally done? As we look to the future, where might prices head to in 2025, and how should both seasoned and new investors approach this ever-valued metal? We explore these trends, the future outlook, and investment considerations with Heng Koon, Head of Markets Strategy for Global Economics and Market Research at UOB, where he leads the in-house team to formulate forecasts and house views for foreign exchange, commodities, and interest rates. Welcome to the show, Koon Hao.
Thank you, Ryan.
Great to have you on. Lots to talk about when it comes to gold because it's been on quite a rally this year. What have been some of the main drivers pushing prices record highs in 2024?
So gold started the year around $2,000 per ounce, popped to about just under 2008 by late October. So it's a very strong rally, right, for the shiny metal. Where we can see it, since like 2-3 years ago, there has been two very, very strong drivers. The first is, of course, central bank buying, or what we call central bank allocation. And we know that emerging market central banks, Middle East central banks, Asian central banks led by China, the People's Bank of China, has been actively buying gold, since like 2 years ago when this geopolitical risk started to pick up. And case to point, as an average, right, Asian central banks, including China, on average has roughly about 5% of the central bank reserves in gold. Developed market central banks, the United States, in Europe, G7, has more than 10% of their central bank reserves in gold. So there's a long lag for Asian, for EM central banks to catch up. So that's the very first strong positive driver for this move up in gold. Now, the second is at the other end of the spectrum, away from central banks, which is retail customers. And we've seen all the news reports, right? And including probably our parents, our grandparents, they're all actively buying gold jewelry, right? Gold nuggets, gold wafers in China, Thailand, Vietnam, and even in the United States, Costco, right? Selling out gold wafers. So that's the retail segment, which is actively buying, gold jewelry, physical gold. That's also a second source of strong demand. So these two strong drivers have been pushing gold higher over the past year.
All right, strong demand from central banks as well as the retail crowd. So gold has been on quite a good run, Koon Hao, outperforming equities even this year. But it suffered a heavy sell-off after Donald Trump won the presidential election. What happened there?
Indeed. So gold topped out just under 2008, late October, and it's now down, at the moment of our discussion, around 2,600 per ounce. Quite a significant sell-off over a short period after Mr. Trump came on board. Now, you notice after Mr. Trump's election win, US dollar is stronger. Long-term bond yields, treasury bond yields are higher because markets worried about the upcoming tariffs that he will impose on China across the world. And markets worried about, the increasing deficit and spending from the US government. So this has lifted bond yields. This has basically supported the US dollar. And this is your short-term driver that has triggered that sell-off in gold because gold is very, very allergic to these two things. But I want to just remind, everybody and all listeners that we need also to be very mindful of the long-term positive drivers that are still there. Because what's happening will not change the long-term trend of central banks buying more into gold. And what's happening also will not change retail investors as a need for a safe haven hedge. Yeah. So be very conscious about the short-term volatility versus the long-term drivers.
Yeah, that's a good point, right? And then looking forwards to 2025, where do you see things going for gold? Are there going to be any new drivers on the horizon? And how much will change in terms of short-term versus long-term views?
So there is a third group of investors that have yet to join so-called this rally in gold, which is the institutional investors, right? The big boys. And they buy into gold products, ETFs. And for them, obviously, the cost, opportunity cost is important because gold doesn't generate any returns. It's not like equities. It doesn't pay dividends. It's not like bonds. It doesn't pay any coupons. So when you allocate into gold as an institutional investor, there's opportunity risk for foregoing that return. So as long as the Fed starts to cut interest rate gradually in the months ahead into 2025, we will see the return of insti investors into gold products, into gold ETFs, and we're starting to see a little bit of that now that the Fed cutting cycle has started. So this will be the third driver that will push gold higher across 2025.
All right, we'll see if that rotation plays out next year. And looking ahead, where do you see gold prices in 2025?
So our forecast for now is $3,000 US dollars per ounce by third quarter 25, which is about a year away. Now, having said that, I want to caution that short term because the market's still trying to understand the policy risk from Mr. Trump, right? What's going to be his trade policy, tax policy, fiscal policy? There will be elevated volatility in asset prices, including gold. So short term, you get volatility, but over the longer run, we see $3,000.
All right, not going to be a straight line and a few moving parts to watch out for in the year ahead. Now, for everyday investors, Koon Hao, what makes gold an appealing choice and what considerations should they be thinking about or weighing before investing?
So for the big boys, the institutional investors, as well as the day-to-day folks like us, right? It is the same reason why you want to own gold in your portfolio, because if it has been tested, time tested, that if you add maybe 3% or 5% of your portfolio weight into gold, it will lower the volatility and the uncertainty of your portfolio. Now, this means gold has, you hear it all the time, gold has good diversification benefits. So you want to do that. Now, as to how much you want to own for gold, that depends on your risk profile. And I guess it's good for all of us to consult your bankers, investment consultants for that right calibration.
All right, a great overview of where gold is going. We've been in conversation with Heng Koon. He is the head of markets strategy for global economics and market research at UOB. Koon Hao, thanks for your time today.
Thank you.